Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the Fed meeting, but also the fact that we've had mortgage rates fall to another new yearly low right before that happens. Logan, welcome back to the podcast.
It is wonderful to be here. Mac Jones and the 49ers come out victorious. In this, I got to tell you this. When I get to scream, "Who dat?" and the Niners beat the Saints on their home turf, it's always a good day for me. And having all those injuries, and I was just not sure about Mac Jones. It was a wonderful victory. As you can see, I'm very excited for football season, and we are good to go.
No, football is what unites this country. Listen, we need football. We need all the sports. So, yay. Well, let's talk about some good news today. We had mortgage rates hit another new low. We're down to 6.25%. And that's, of course, ahead of the Fed. So what's leading mortgage rates down that far?
Another day showing the benefits of mortgage spreads. This is a very, very small, narrow example, but the 10-year yield fell a few basis points early in the morning after the manufacturing data. The headline missed estimates, but the internals doesn't look good. And it's funny, right when that report came out, I was making a video chart about manufacturing jobs, and manufacturing jobs actually peaked in November of 2022. It's been falling ever since. Not a lot of people know that, but it's been very slow. Usually manufacturing jobs by itself won't create a recession in America. We had manufacturing recession in 2015-16, but when manufacturing data and residential construction workers lose their jobs together, that's never a good sign. So the 10-year yield fell a few basis points, didn't get to as, sub 4%, it's about 4.03 right now. But it gave us fresh, new low mortgage rates of the year right before the Fed meeting. Fortuitous timing, because by the time this podcast comes out, the builder's confidence data, retail sales will come out. So if those data lines tend to improve, maybe yields go up a little bit before the Fed meeting. But what a way to start the week off.
Yeah, really. And we're talking I think we're down 1 basis point from the previous high, which was down like 2 basis points from the one before that. So it's ticking down very slowly, but we will take it. It's going in the right direction.
Yeah, I think the yearly low was 6.27, and then it went up to 6.29, and then now it's 6.25. So we're kind of officially in the lower range, 0.5% left for the downside. And again, look at all these things that happen, the labor data getting really softer. Some of the manufacturing data is coming in weaker. Housing starts and permits are in recessions, and yet we're still 6.25 with, 4% plus 10-year yields because the Fed is, again, still modestly restrictive, and they raised their inflation expectations this year. So those things actually matter. And it could maybe, you could get an idea why we're still at 6.25 with mortgage rates today.
And of course, the big question is, what does that mean when we're on Fed week? We're looking at what the Fed's going to say. And that's something that you talked about with the housing market tracker over the weekend. That's kind of what you were looking at. You did a deep dive there. I would encourage anyone. That was great. Remember, you and I had a good discussion because I was like, maybe we should just publish that as its own thing. We'll publish the tracker, all that. Went back and forth because it was such a good deep dive into why we are where we are with mortgage rates.
And I told you no, Sarah. It goes into what?
You did. We had a good discussion.
You know what? Haven't I improved on writing the tracker? It used to be like 2,000, 2,500 words, and it's just like,
When you first started writing for us, it would be like 4,000 and 5,000 words. It would take me hours to edit. You're so good at it now. And most of your trackers are, right around, under 1,000. This one was a little bit longer because you did a deep dive there, but I appreciate it. And you've just gotten better and better.
Yeah. And with mortgage rates, again, as always, 65 to 75% of where the 10-year yield and 30-year mortgage rates can go is Fed policy. And we're in a very unique spot with the Fed meeting. If it was up to me. It's more or less trying to hold these lower rates for a longer period of time because some of the data lines get better and the Fed doesn't have to worry about it. But, again, housing starts and permits have been in recession for years. So I think we talked about this last year, and I said when residential construction workers lose their jobs, the Fed tends to ignore it, right? It happens every time. They tend to ignore it. They don't acknowledge it, and they say, well, the economy's strong, and all of a sudden a recession happens here. they have time, and you don't have to have rates at 3, 4, even 5%, but housing typically does better when rates are near 6%, especially for the builder. So when this comes out, the Builder's Confidence Index is one of these things that are now working for a very low level. So it's a low bar to beat. And these are the smaller builders, not the big publicly traded builders. Their stocks are doing really well. So I think, to me, I'd really love to hear their verbiage on trying to maintain these instead of, allowing the marketplace to say, oh, listen, the Fed is going to fight inflation, and they want higher rates. There's something where you can kind of get to the point that we'd like to get to neutral faster, and we're discussing what would need to happen for an accommodative policy, which means an accommodative policy changes the entire landscape for the bond market, for the Fed, and everything out there, because we've never talked about trying to stimulate the economy ever. All we've done is, how long does it take to get to neutral? That's the whole modestly restrictive stance.
So I think it's interesting that you picked up, you were talking about manufacturing data, because we know that a big part of what the Trump administration is trying to do is to drive manufacturing back to the United States, right? To grow that sector. So maybe talk about that. Like, what does that look like? If it's been in decline since 2022, maybe that's one of the reasons it's a focus of his to try to get those jobs back.
One of the bigger things I've ever written in my life was the 2016 article about manufacturing under President Trump, and that there's limits. There's the simple laws of limits to how much growth you can have in a sector where the output is so much different. Housing needs labor to build homes, because we still build homes with hammers and nails. Manufacturing, it's not just the exporting of manufacturing to cheaper. It's the dollar's very strong here in the U.S. and technology that, you're not going to get this massive big boom of manufacturing jobs. I laid that case in 2016. You can get some growth here, but we have to be realistic on what can happen or what promises can be made. But again, manufacturing has been slowly moving lower since November of 2022. It's been quite a negative sector in the U.S. here. And I just think it's hard when you're a consumer-based economy and people love cheaper things, and you have the reserve currency of the world. It's hard to get people to, build stuff here in America, right. Pay more, and then have the costs go up, and have consumers that are not disproportionately even with the income scale all of a sudden think, okay, can this work? And I think one time they kind of let the cat out of the bag when they said, well, we just want manufacturing as a percentage of GDP to grow. And, some of the charts that I wrote in 2016 gives you a kind of an outlay. This is why I've always said that Trump really needs a lower dollar. You cannot have a strong dollar. If you want to be a manufacturing country, if you want to build stuff and sell it, or outside, or you need a weaker dollar. So two of the three things he has now. The third one is, we always say, the Trinity effect. He wants a lower dollar, lower energy prices, and he needs lower mortgage rates. So what Trump's whole, at least how I interpret it, what Trump's whole game plan was getting those three things, and finally mortgage rates are coming down to a lower part of his plan. And he believes, at least I think he believes this, with lower energy prices, lower mortgage rates, and a weaker dollar, he can offset some of the chaos that the tariffs can cause.
I did want to bring up, because we were talking about mortgage rates. We're talking about last week. I mean, we've been mentioning mortgage fraud and them going after, Federal Reserve Governor Lisa Cook. And we did get some, on Friday, news broke that her loan estimate, at least, had that she had put down that her property was for a vacation home, so not primary residence. So now there's a lot of question about, like, okay, well, where are the other documents that Pulte talked about? Are these, what's going on there? I was not able to find the documents across the board from Pulte or the loan estimate. So I know that other news outlets have the loan estimate document. So I thought that was interesting and something to bring up, because we have said, oh, okay, this is something she's done. So I wanted to bring up also that there might be some question now on whether that is mortgage fraud, and whether Lisa Cook will continue may continue indefinitely to be a member of the Federal Reserve.
Loan estimates are loan estimates. They're not official documents of the paperwork. I actually thought it created more questions about this. To me, if she says it was if her attorney says it was a clerical error and that Biden's team didn't look at it enough, and then somebody comes out with a loan estimate, something doesn't add up there. Like, I mean, if it was simply, hey, listen, it was a vacation house, then the attorney would say it. A loan estimate can give you a preview or a rate or whatever it is in that you need the final paperwork. But again, this is all smoke and mirrors in the big picture of things. Trump is playing New York bully ball. He's already got one Fed member to resign early. He's going for another person. It doesn't really matter too much for this Fed meeting because Dr. Cook was one of the more dovish people out there. So it's not going to be an issue if he can't get somebody else in. Then going out, it's a little bit different. But again, to me, this is more about putting his rubber stamp in it for the next few years out there. And again, we said this many, many months ago. They are going to go after Fed governors, right? And they are literally researching. They are hiring specialists to find anything possible to hold it against you. And we said there are skeletons out there. And Colger retired early. We'll see what happens with Cook. This still might not be over with, right? I'm lucky for Beth Hammack. Beth Hammack's not a voting member because she would have been, Trump would have been all over that. What are you talking about? No rate cuts. So it's one of these things where it's very unorthodox. However, if you've seen how Trump has operated for the last few decades, it's very normal for him. So, whatever it happens it's not going to matter so much for this Fed meeting going out in the future. It is. And again, they have not pulled a shadow Fed president card yet. Again, partly I believe Trump likes to have a punching bag, but also I don't think he's quite sure about Christopher Waller because he's a Fed member already. Trump wants loyalists, and Kevin Hassett will do what he's told. And Trump might feel a little bit more in control with having Hassett or Kevin Warsh in there rather than Waller, who a lot of Wall Street people will respect and say, okay, listen, we're not going to go crazy land here. If rates do need to be go up or rates need to go down, he'll have at least a coherent argument and he'll try to rally up the board members to join him.
I think the important thing here is no one expects that even if he packs the Federal Reserve, I mean, you can't really get to the emergency rate cuts that he wants. I mean, I think if you did that, it would throw, a lot of things. I don't think that would be good, right? I mean, how could they cut rates?
Emergency. We're talking about emergency rate cuts. That's how crazy this world is. To get the Fed funds rate down to where he wants below inflation, that's not going to happen. I mean, I mean, Scott Bassett wouldn't even advocate for that. I mean, he hasn't been advocating for that as well. So I think to me, it's like if the 10-year yield is between 3.80 and 4.25, and the spreads are better, I think they could live with that to a degree out there. But I always thought this to be they want a lower dollar, and I think I'm an economics person first, housing second. So to me, you cut rates and you lower the dollar because that's what he needs for manufacturing. That's why I always say that Trump's going to go after a lower dollar because that'll work better. The dollar got too strong early on. My joke was always in the last few years, I'm going to be the U.S. dollar for Halloween. If the dollar hit 115, that's going to be an absolute wrecking ball, and I'm just going to be the dollar. Like I was John Wick's pencil one time for Halloween, so the U.S. dollar at 115 would be worse than John Wick's pencil.
Listen, I do enjoy a good John Wick movie. I don't even know how many of them there are. They're always on TV, and so I've seen all of them multiple times. Usually, while I'm cleaning.
The John Wick thing. I went and watched some of my debates with the Doobers. when I went on their YouTube pages and stuff. And I gotta tell you, I'm like the John Wick of America going after the American Bears, for this. I mean,
Okay,
the,
I
the,
don't
the,
want that.
the
That's too high of
fact
a body
that
count.
these people actually let me go on a show with them, and they've actually, I encourage everyone to go back and listen to some of these things. We had a gentleman come on our Housing Wire,
We
two of
did.
them
We
in
did.
2022 and 2023, and they just threw stuff up in the air. And we're like, y'all just making stuff up. Y'all just throw it. We always say people just make stuff up. They go 10%, 15%, 20%. Why? That sounds very good. And
I think the thing that's surprising about you in a debate with people is you are very gentlemanly, but you kill them with the data. You're not like yelling at them. You're not disparaging them. You're just like, okay, so what about this? Okay, well, let's talk about the 5-year. Okay, what about, and it becomes obvious pretty quick that like they may not know what they're talking about. So I
my
would say
my
that.
my mentor taught me that if you're going to be in a war, make sure your enemy is very overconfident and allows you to get close enough for a sword. Use their overconfidence against them. And then when you get them into a live debate and everyone gets to see the name, face, and then for the next 20 years, they have to forecast and they can't do it. I know that, right? So not only is the accumulation of 14 years of crazy calls, but it's the next 20 years that I want, because you force these people to do something they cannot do that I know they can't do. You just got to make them, lull them to sleep to let them get you in. And then you go, okay, I'd like your last 5 years forecast in a working model. Can't do it. And then the next 20 years, so I think people have finally figured out what I'm doing here. And now it's like quiet land. Nobody's ever saying anything.
They're like, no, let's do
That's the John Wick of housing right there.
Okay, less killing involved, hopefully. Okay, let's talk about the other things that you pointed out in the tracker, especially housing inventory, because that has been kind of weird in August, right?
Well, again, for us, we always believe looking current and forward, and the housing tracker kind of picked up a little bit change in the data mid-June. Mid-June is when actually the 10-year yield started to go lower. And then when the 10-year yield even reversed, it wasn't very bad because the spreads were getting better. So all I saw was a stabilization. Then July, the 4th weekend came and ruins everything for 2 weeks. Yeah. But then in August, we had a very, very rare decline in total inventory. And part of that is I think the percentage of inventory grew very good this year. I was very happy. That's still, to me, the best story of housing in 2025. But it was just very hard to hold up. I didn't believe we peaked in August. I thought, we could get maybe a few more weeks where we get a little bit higher, but that has not been the case. And then 2 weeks ago, inventory had a big drop, and then it correlated with rates falling, and people were saying that's the peak of inventory. And I was like, no, wait 2 weeks. You got to wait 2 weeks and then let the holiday weekend work itself out, and then we get back to normal. And that's exactly what happened. Last week I talked about, inventory should pick up. Inventory picked up to where it kind of was before. The new listings data is negative year over year, but I think that works itself out. As we get closer and closer to the end of the year, the new listings data starts to compress lower and lower like it does with other years out there. So I still think we're showing year over year growth in new listings. It's just a holiday working itself out. The only thing that surprised me about the tracker is I thought the price cut percentages would pick up just a little bit. That didn't case. That kind of stabilized. So you can see now the aggregate data from June, we go to July, August, and now September. So we have 3 months of data. It's stabilizing, right? So what was happening earlier in the year is different. And now mortgage rates are lower. And so far, we've had 6 positive forward-looking purchase application data. You need 12 to 14. What we've never had in many, many years, positive weeklies and positive year-over-years together. It could be the first year in many, many years that I could actually say we have 12 to 14 weeks of a positive weekly and year-over-year trends. The whole year we've been pretty much positive year over year, but the weekly data just wasn't as strong. Rates were volatile just a little bit, but we just were never under 6.64. So as soon as rates got under 6.64, it has been a pretty clean positive weekly and year over year data. So it'll be very interesting if the next 6 to 8 weeks gets that full thing complete. And then purchase apps usually take 30 to 90 days to fall into the sales. Our weekly pending sales and pending contract data are still showing slight year over year growth. So we'll take it at that point, but it is encouraging that we saw all of this with elevated rates, and now we're getting down to here. And this is not the sub 6% mortgage market world, because, the builders, new home sales are at 2019 levels. That's like a million to 1.2 million more existing home sales if we wanted to run a model based off that. But we don't have a sub 6% mortgage market, so we don't go there at all.
I love it. Well, there's so much there. The reason that it takes you, 1,000 words to do the tracker is because you're tracking like 10 different things. So it's very succinct on each one, but I would encourage people to go look. We've made it easy. Now it's at housingwire.com/housing market tracker. And also encourage people, we are getting really close to October 7th when you are going to give your what the bleep is going on with housing at our mortgage banking summit. So people should come. They can interact with you. We've got a lot of great speakers. It's going to be incredible.
It's funny how things change so fast, with housing data, because when a sector revolves around the bond market, right? And the chart daddy says, I wake up, I'll go to sleep, the 10-year yield is right next to me. I'll get up at 2:00 in the morning and I'll look at the 10-year yield and I'll put some tweets out and people go, you never sleep. And I go, that's absolutely right. How things can shift since late 2022, right? Since late 2022, we've had some supply and demand equilibrium shifts, and it really revolves around the 10-year yield. And it's when the 10-year yield gets toward 4% or under that some of the data lines have shifted. Late 2022, it shifted last year, but it's usually when rates get towards 6%. And we've tracked this and we show people this. And I think the tracker's job is to get everybody in line to what's happening now, and that'll happen in the future in the sales reports, because everyone is still reading old data. Like, it is funny to me that people are still reading data from like 3 months ago and they go, oh my God, this is really happening. So I have had people literally tell me this is exactly what happened in 2007 and 8. This Case-Shiller price. And I said, Case-Shiller's still up year over year? They're like, what? I said, you don't read. It's okay. But in any case, this is the exact opposite of the supply and demand equilibrium of 2008. But how fast things can change, right? And then last year, mortgage rates had gone up. We got back up with over 7%. The question is, does this happen again? And we're going to spend another year in 2026 trying to. But the one thing about short-term rates falling is that those ARM products are starting to look juicy, right? And if the spreads are still wide, like if the spreads were normal, we're at 560, 580. On the 30-year mortgage, right? So, but if the spreads are still wide, but the short-term rates keep on going lower, that those ARM products look more enticing out there.
Oh, it's going to be really interesting. Of course, we are on pins and needles about the Fed. We'll be covering that completely every single day. So, Logan, thanks so much for being on here. John Wick, thanks for being on.
Pencil. He killed a man with a pencil. That was one of the greatest scenes. He's literally telling the kid, do you know who you're talking about here?
Oh, very, very apropos. Okay, we'll talk to you later, Logan. Thank you.